Hi, welcome to Financial Education for the Nation. My name's Warren Shute, and I'm here on this overcast day with this delightful Paul. How are you?
Hi Warren, I'm good. You well?
I'm very good today, actually. I'm very good. I look forward to our chats every week, and today is a interesting conversation we're going to have.
Yeah, so the financial crisis has been in the news again this week because of the 10th anniversary since it happened, which is shocking in some ways in itself. And I thought we could just kind of talk around that about what happened, what's been happening since, and what might happen in the future as well.
Yeah, sure. It was a I would say shocking is the word, shocking experience. So I was a financial planner in the dot-com crisis, the 2000 correction of the stock market, but I was fairly early in my career. So that happened, I started in 95, so that's like in the first 5 years. So I was sort of less experienced. So when this one came around, I felt I handled it differently, better, but it was still shocking. It was still shocking. It was surprising to see the fear. It's also surprising to see the fear that the papers and the news really fueled and generated, but it was a scary time. Basically, what we had was a failing of the financial system, and that was what then instigated certain companies to go insolvent or bankrupt. I think it started with Lehman Brothers, and in the UK we had Northern Rock because they had overextended themselves to exposure of mortgage debt, which was being defaulted on, so mortgages weren't being paid. Therefore, the banks weren't getting their money back. Therefore, those assets were written down. And therefore, those companies were insolvent, so they can no longer trade. And in the US, the Americans let Lehman Brothers go to the wall. In the UK, we bailed out Northern Rock and packaged it up together and sort of made things sort of carry on, really. But it was a systemic failing. In other words, the whole banking system failed. What it accumulated in is that the stock market fell about 50%, which is a similar percentage loss. I think it's about 47%, which is a similar percentage loss that we saw in the 2000 dot-com bubble as well. And the reason I relate those two is they are the two significant events that if you look in the last 20 plus years of financial history, when you're looking at performance, they're the two major falls in the stock markets. And that really gives us now as planners some kind of benchmark to say, hey, look, this isn't the maximum loss that you can achieve if you invest 100% in equities, but this is a significant time in history on two occasions where the market's corrected.
Okay, and I want to come back to what you've just said there about the different ways that you handled it in just a moment, but I read something by Gordon Brown this week, for example, who was perhaps unfortunate to take power just before that crash happened, talking about the UK financial services sleepwalking, in his words, into another potential disaster. And there seems to be people talking around that something similar is probably not too far around the corner. And our economy does have this boom and bust cycle over history, and it will happen again at some point. So if people are worried about that, how can you mitigate, if you've got investments, how can you mitigate your exposure, and should you be worried?
Sure. Okay. So I think first thing is, I think it's really important to look at facts and to appreciate that investing is a long-term experience. And that these aren't losses. They're times when the assets that you own are priced at a lesser value. And virtually always, certainly the markets as a whole, these assets will recover over time. So one thing you can do is you can say, well, look, what's my time horizon? What's my time in which I need access to this money? And as we've said time and time again on this show, anything from 5 to 7 years, you really need to be diluting your stock market exposure. If you're 7 years plus, you can accept more stock market exposure. Does that make sense? Do you understand that? Yeah.
Yeah, so that you've got time to ride out the waves.
Yeah, so let's run a scenario. If you are approaching your retirement this week, you shouldn't necessarily be 100% exposed to the stock market. And in my book, The Money Plan, I give a really simple rule of thumb example of 100 minus your age is a good allocation to consider to the stock market. So in your 20s, we've got 100, minus 20 lives as 80. You can have about 80% of your money exposed to the stock market because you've got all those years on your side for growth. But when you get into your 80s, 80 less 100, 20, maybe only 20% of exposure to the stock market. Still some, but a lot lower amount, because we don't have the time to recover those losses, which are the financial crisis, the dot-com bubbles, that kind of thing. The stock market as a whole at the moment is fairly valued. So it's not cheap. It's definitely not expensive. It's sitting around the long-term average. At the peak of the financial crisis, the dot-com bubble, the PE ratio, which is a valuation measure, was hitting around about 33. And typically the market sits around 15, so half that. And we're now around about 14. So spitting distances of the average. So although we've experienced one of the best bull markets, the longest bull market ever, so that's basically a stock market that keeps growing, we're still fairly valued. Okay, so that doesn't necessarily mean that news instances like Brexit negotiations, like a country defaulting, something like that, or a terrorist attack won't have a volatility effect on the market, but that should recover, and markets are priced fairly, so therefore markets should still continue to grow. I don't see any reason to go back into a financial crisis or a dot-com bubble.
Okay, so if we are looking to invest, if we have some money to invest, we shouldn't be holding off because we're worried about what might happen with Brexit, as you say, and kind of over the next 12 to 18 months. We should just, again, with that long-term outlook, we should still invest the money.
Yeah, I think first step is ask yourself the question, what's the purpose of investing? Why am I investing? Now, it sounds an obvious one or maybe a silly one, but if you don't know why you're investing, then why would you invest? We had lots of people jump on the bandwagon of cryptocurrencies, and they've just gone through the floor. They've just crashed out of oblivion. So people have lost a lot of money there. And really, what's my outcome? Okay, so this is for my retirement. This is maybe for my children's university or something like that. What's my time horizon? Second question. Is it more than 7 years? Yes. Okay. Now, how much can I accept from a high to a low? I'm investing £1,000, £10,000, £100,000, £1 million, whatever it might be. How much can it go down before I now begin to feel uncomfortable? So I'm now feeling a bit unsure. I was okay at the time, but now I feel unsure. Once you establish how much that drawdown is, you can then invest in the stock market and take more stock market exposure. And we typically say, if you go 100% in the stock market, you should expect your portfolio to fall 50%. And that goes back to the dot-com and the financial crisis. If that's too much, you maybe say, well, okay, 50% fall is too much, but 25% is acceptable. Then maybe you put half the money in the stock market and then half in low-risk investments, short-term bonds and things like that. And if you go to lexo.co.uk, there's a range of 10 portfolios on there that show you the drawdowns, how much the portfolio has fallen, what the returns have been over about 20 plus years as well. So it gives you a lot of data. And that goes from 100% stock market portfolio, so Lexo 100, goes down in increments of 10, so 90, 80. And you can see a 50% stock market portfolio fell by about 25%. I think it's about 23%, like that.
Okay. All right. So coming back to the anniversary of the crisis, it changed a lot. There's been a lot of new regulations come in. There's been a lot of changes to the banking system as a result of what you were talking about earlier with the collapses. And are we now in a better position, in your opinion, as a country to withstand a kind of shock effect?
I think that there are an awful lot more preventative measures in place to prevent that kind of thing happening, or the same thing happening. The regulator might have been, the FCA might have been told that they were slow off the mark in preventing it. But however, in hindsight, retrospectively, they have certainly tightened up the belt. And now if you've applied for a mortgage lately, you'll appreciate how much more difficult it is getting a mortgage now than it would have been 10 years ago, pre-crisis. So yes, we are in a much stronger position. The regulator's done a lot of work in making sure we're safer. Will a financial crisis or something similar happen again in the future? Yeah, sure it will. Just like dot-com happened, just like the financial crisis happened, the next one will happen. What that is, I have no idea. No one does know. When it happens, no idea. We don't know. It's not, we are cyclical, but it's not timely. It's easy to say, oh, there's about 10 years or so between the financial and the .com, so we should expect one now. Yeah, we could say that, but there's no rule in society to say that happens every 8 to 10 years. It just doesn't happen. The biggest correction or financial crisis prior to 2008 was back in the 1930s. So that was the Great Depression. So, will it happen in the future? Most likely, because greed and extremes drive people. They see the market go, they buy more, it goes up and up and up, they try and make more money. Therefore, reality sets in and it corrects. But like I said a few moments ago, we're fairly valued at the moment. We're not expensive, we're not cheap, we're bang on the money. So there's no real reason to see a fundamental, institutional type correction or pullback in the market. We've got Brexit coming up, negotiations, that's scaring people. Things I'm sure will pattern out. If we've got 7 years to our retirement, hey, we'll be through and out the other side by then. And if you're in the next couple of years, then yeah, you should be taking advice. Go to Wayfinder, which is a certified financial planner register. Find yourself a good CFP, and then go and get some advice from them. Say, hey, look, I'm retiring. I need to get some advice.
Okay, and outside the markets, I guess looking at property and just generally with wages, some areas of the country on both property and kind of economic development are doing better than others. That's always the case, of course. But can we prepare and try and manage our risks when it comes to that, particularly with Brexit, which is obviously the big headlines dominating the media? Are there things that we should be doing to kind of prepare ourselves? If I'm looking to buy a house in the next 6 to 12 months, should I be holding off?
Okay, so when you buy a house, I guess there's typically most people mortgage it, and therefore there are two variables. There's three really. There's the actual value of the house. There's the interest rates you're going to pay to do that. And there's the security of the inflows of money, so your earnings, to service that debt. So they're the three things when you're buying a property or an asset which will be affected. If you're buying a home, typically we stay in the home for 7 to 10 years, like that. So, and with the cost of buying a home, I'd recommend you stay in it as long as you can. So I wouldn't put off buying a house now if you, just because you're concerned about Brexit, if it's the value of the house. Buy now, hold on to it. It'll wash its feet. It's your home at the end of the day. You want to be settled. Once your home is settled, you can then think about other things. Interest rates, it's very likely we will start to see a rise in interest rates. And the reason for that is we are below the norm. I spoke about the valuation of the stock market being about norm. With interest rates, we're below the norm, below the average. And it's more, with inflation picking up, inflation about 3.6%, it's likely we'll see a rise in interest rates to keep a hold on that inflation. Now, if when we go through Brexit, the economy slows, inflation isn't going to pick up, and therefore interest rates won't rise. The only reason it's going to stimulate interest rates is the economy picking up, which is a good thing for everyone. So it's almost like, well, if interest rates rise, I'm not so worried because it means I've got stronger work and the economy's good. If interest don't rise, that's fine, means the economy's slowing down, so I'm not going to get penalised for higher interest rates. However, if you're going to take a mortgage out, why don't you fix it? Just fix it for, say, 3 to 5 years. You know where you are, you've got your payments sorted, and that's fine. And the last thing is security of income. How secure is your income going to be now and through Brexit and post-Brexit? Are you in a job that potentially could be lost because of things that are going on with the trades? And if you are concerned, that would be the main reason for me to say hold off buying a property. But it wouldn't because of interest rates or property prices, but purely because, well, actually, my job is insecure. I don't want to get a financial commitment and get myself into a pickle, as it were, if something happens. But for most people, I would imagine their jobs are going to be secure going through Brexit. I can't see of a reason that lots of people are going to see mass unemployment. Okay. So, they're the three sort of fundamental things with regards to, Brexit and property prices and things. Okay.
So I think then overall, I guess the message I'm getting from you is kind of your mantra as well. It's all about proper planning and having a strategy or a plan in place for your money generally, as well as the specifics like investing and property and things like that.
Yeah, I think, a lot of people generally will just walk into things and decide without thinking of the consequences of the knock-on effect of what happens in the future. And it's all about, well, okay, I'm in a rented house, or I'm in a house that's not appropriate for my family. I want to move. You may not get the absolute best price, but maybe that's not the whole thing about the plan. The plan is we need to be settled. We need to be in our home. We need to then maybe get on with our work, enjoy our family life, and also focus on the things you can control, not the things you can't. I have no influence whatsoever in the Brexit negotiations, so I keep an eye on them, but I don't worry about them. I can't control the stock market, so I keep an eye on it, but I don't worry about it. Focus on what you can control as opposed to what you can't. And be careful to whom you're listening to and what you're listening to, because sometimes I read the paper, I listen to the news, and I think if I didn't know better, I would be worried. And I actually want to tell them that what they're saying isn't actually quite factually correct, and they should maybe tilt it both sides. And I go to the BBC too. So, it's be a bit more neutral.
Yeah, agreed. Okay, so I think then, 10-year anniversary or no, it's a great time to start the money plan then, right?
Yeah, I think so. At the end of the day, in the last 10 years, the stock market is up about 100%, maybe a bit more. So, if you'd invested £1,000 in the financial crisis 10 years ago, so we're not talking the bottom, we're talking, when the financial crisis started, because it carried on going down, you'd have doubled your money by doing nothing. And that supposedly was a really bad time to invest. We're still fairly valued. So maybe if we invest now, 10 years time, what will the valuation be? I have no idea, but it's going to be pretty good, I would expect. It's going to be pretty good. Property prices in general, on average, I know you highlighted to me pockets of the country that have done really terribly bad, but in general, throughout the UK, property prices have gone up or stayed flat. So, life isn't so bad. I think wage price inflation has been pretty tough for most people, particularly those in the public sector. So wages haven't increased what they probably should do. We've seen inflation being fairly flat up until recently, but we now need to see those wages start increasing. At the end of the day, we need our wages to at least keep with inflation. And if we're training and learning and adding more value, we want to see our wages go up by at least more than inflation. So, the last 10 years haven't been quite as bad as some of the news pundits might have said.
Okay, great. Well, thanks very much for the wrap up.
That's cool. All right. Good speech, Paul. See you next week.
Take care.
Bye-bye.